Thank you, participants, for joining in. We'll wait for 2 minutes for the members to join in. Hi, friends. Good morning. My name is Nayan Manyar, and on behalf of ASK Investment Managers, I welcome you all for a quarterly update call of Financial Opportunity Fund. Today, we have with us Mr. Bhavesh Kanani. Bhavesh Kanani, who manages the Financial Opportunity Portfolio, has an overall experience of 20 years into equity research in both global and domestic market. His domain expertise has been banking and financial services. Prior to joining to ASK, Bhavesh has worked with Centrum Financials, Sharekhan, Bank of America, and Citigroup. He is an MBA in finance from IBS, Mumbai. He has been associated with ASK Investment Manager since 2013, which is almost a decade. Today, we have scheduled this webinar wherein Bhavesh would cover the broader trends in the markets for 10 to 15 minutes, along with deeper understanding of ASK Financial Opportunity Portfolio, and will give us the insights on what has happened till now in the financial year 2025, and how we see the things going forward. This session would be followed by Q&A, and I would request all the participants to type your queries relating to the portfolio in the chat box. We shall curate all the queries and try to address the same. Without taking much of the time, Bhavesh, thank you for joining in, and would request you take the session forward.
Thank you, Nan, for the introduction, and welcome everyone to this presentation. Well, idea is to first review the trends we have seen in financial performance as well as the macro trends pertaining to the financial services sector. To begin with, let's review what has been happening on the banks front. Broadly, last couple of quarters, the challenge has been that deposit growth was below the credit growth. And as a result, we have seen all the banks being very aggressive on hiking term deposits almost for last 1 year or so. However, incrementally in recent months, what you have seen is that credit growth has moderated and deposit growth has improved a tad, with the gap between the two now practically non-existent. And if we were to talk about segments, individual segments, we can see that certain segments like gold, MSME, service sector have done pretty well on the growth front, whereas there is growth moderation in segments like NBFCs, that is, banks giving loans to NBFCs, as well as large corporates where the growth continues to remain pretty weak. Uh, from entity perspective, as the exhibit here shows, there are a couple of entities who have grown at higher than the industry average of 12, including some of the large banks on private side. Notable growth rate of HDFC Bank, which was at around 7%, because after the merger, the CD ratio for the bank had gone above 100%, and they are trying to repair that on the balance sheet, and as a result, they have clamped down on growth. And this is a result of both lower growth as well as sell down of some of the loan portfolios by the bank. Uh, Another notable feature in recent quarters has been the manner in which unsecured products growth has continuously moderated. And by unsecured, I'm referring to personal loan, credit card, and microfinance loans. As we can see, FY24 growth, Q1 25 growth, and then Q2 25 growth for all entities has been moderating. And that also had strong bearing on the overall loan growth we saw for individual entities. On deposit front, year-to-date growth, that is since 1st of April, the system or industry has grown at 4%. There are certain entities which are doing better than the industry, whereas there are other entities who are growing at a rate slower than the industry average. Equally important is the CASA market share. Largely, the entire industry has seen erosion in CASA because of higher term deposit rates. Customers are moving their saving balances to term deposits. Only three gainers in the CASA market share game, namely HDFC Bank, ICICI, and Bank of Baroda. That is for the Q2. In terms of interest rate environment, liquidity situation has improved in the recent months. It continued to remain in deficit for the previous quarter, deeply in deficit, but gradually we have seen improvement. And as a result, the average call rate for Q2 was more or less the same as in Q1. Now there is a lot of anticipation that rates are near its peak, and as a result, one of the tools banks tend to use is the short-term CDs, which are of the duration of 1 month, 3 months. Raising of the CD has gone up dramatically because the banks do not want to lock in deposits at a higher rate for longer durations. Uh, as we were discussing earlier, the TD rates continue to move up. These are the kind of changes we have seen in term deposit rate right from 1st of April till date. As we can see, there is a fair bit of hikes seen in the 1 to 3 year bucket as well as the shorter end, and less so in case of rates beyond 3 years. If we talk about entity level, then HDFC, Kotak, and ICICI among the large private players, and SBI and Bob among PSU have taken higher rate hikes compared to the peers. On operating efficiency, clearly we can see that revenue growth, it's kind of a mixed bag in one sense. And we have seen a lot of investments done by private banks in technology front for PSUs. There was a high wage in 24 because of the wage revision related provisions. As a result of all this, revenue growth was higher than the OPEX growth. Naturally, there are a few exceptions like IndusInd Bank and Kotak Bank, where OPEX growth was higher than that of the revenue growth. And the implication of that we can see in terms of cost to income ratio as well. On asset quality front, which is kind of the focus area in recent times, all across the products, we can see different behavior. When it comes to retail as a broad category, the slippage ratio is largely same uh, for secured. However, for unsecured retail category, we can see the slippage ratio is gradually inching up. Within unsecured, these are the data points for personal loan and credit card. We'll dive into the microfinance segment a few minutes later. Similarly, this is bank-wise disclosures for the unsecured retail piece. We can see that for PHUs, there has been increase in the slippage rate. Private banks, while the slippage was already high, is behaving in a stable manner. However, for small finance banks, there has been a dramatic increase in the slippage rate, as a result of which there were implications for the credit growth as well, which we discussed earlier. From the total stress perspective, the stress loan ratio is largely stable for the entities. There was some bit of uptick for Kotak Bank. Otherwise, for most of them, it was stable sequentially. Provisioning coverage too, if you look at this exhibit, remains well above 70% for all the players. Some banks like ICICI and Axis are maintaining much higher provisions, and these some of these banks also hold a strong contingency provisioning buffer as well, which is not necessarily captured in this 70% contingent ratio, but is displayed separately here. Uh, and on the actual credit cost front, as we have been highlighting in past webinars, that the best of the credit cost that we have seen in last 2 years will gradually normalize upwards, and that trend continues upward normalization. And practically for all the entities, we can see that credit cost, which is how much provisioning is done through the P&L, is on the rise compared to the past periods. This is the MFI business GNPA status for all the entities which are material in this microfinance business. As we can see, the GNPA for all these entities have shot up in Q2. Largely, this is because of the fact that there are a lot of borrowers who have taken more than four loans, and with more than four loans, the over leveraging started to hit in terms of asset quality. There is a recent guideline from the industry association MFIN, which is trying to put a cap on this number of loans per borrower as well as exposure. But at this stage, whatever is on the book, which is facing stress and facing the brunt of over leveraging, that will flow through the GNPA over Q3 and Q4. And only with time, the repairing of balance sheet will happen based on the new guidelines from MFIN. Because of the NIM pressure, because of the rising credit cost and slower growth, we have seen moderation in ROEs for some of the entities, whereas for some of the entities, they've been able to maintain their ROA on Y-on-Y basis. There are only two entities, SBI and Bob, which have seen ROE improvement on year-on-year basis. And as a result of these kind of fundamental challenges on asset quality, the valuation for most of the bank is very close or marginally below the 5-year average price to book we have observed. On NBFCs, AUM growth has been moderating, though if you look at absolute number, the growth rate is still pretty healthy. We saw the asset quality data for microfinance companies, and owing to those challenges, the growth rate has decelerated sharply for the MFI players. Whereas for affordable housing finance companies, the growth has not moderated dramatically as much as it has been the case for MFI and some of the other NBFCs. And on the margin front, the experience has been a little bit mixed. In some of the cases, we will find that NII growth is higher than AUM growth, especially for RECPFC to an extent for Shriram Finance and Chola. Whereas for a lot of other entities like Bajaj Finance, NII growth has been lower than AUM growth. So has been the case for some of the affordable housing finance players. And this reflects uh, nothing but the NIM compression they are facing. Entities like India Shelter and Aadhar have performed better for different reasons. Both of them IPO'd recently, especially Aadhar, and in case of India Shelter, large part of the loan book is fixed rate in nature and hence different trend for them compared to the peers. In terms of overall financial performance, more NBFCs AUM growth could not translate into equally strong bottom line growth. We just discussed the mixed trend we saw on the NIM compression front. The other important factor was higher provisions. Just like banks, here too, we are witnessing that gradually the credit cost is inching up, driven by gradual uptick in the GNPAs. Microfinance lenders have seen a sharp decline in profitability because of the fact that GNPAs have shot up, and in response, these microfinance lenders have provided aggressively for the pain that is already on the book and some bit of pain that is likely to come over next few quarters. On life insurance front, we saw healthy AP growth for most of the players except for SBI Life, with growth being about 20% for most of these players. A large part of the growth was driven by the ULIP segment, as has been the trend in recent quarters. However, on Q-on-Q basis, there was some uptick in non-par sales, which helped the VNB margins. Now, this uptick in non-par sales was primarily driven by the fact that term deposit rates or fixed income rates in general are at its peak, and so clients were suggested that they can lock in this higher rates for a longer period of time uh, to non-par products rather than term deposits. And as a result, there was some brisk sales for non-par products during the quarter, which helped the VNB margin. The impact of change in surrender value charges are yet to trickle into numbers. That will happen over next few quarters. On non-lending financials, this is the brightest part of the financial services business, as is visible in the very impressive revenue growth. Except for rating agencies, we can see that the revenue growth for wealth managers, asset managers, and RTAs was about 30%, and bottom line growth was even higher than the revenue growth in case of RTA especially, and amongst AMCs for Nippon. Exchanges continue to report very strong numbers led by volume growth and benefit of operating leverage. Incrementally for exchanges, the new guidelines for SEBI are in process of getting implemented during the month, and we will see some bit of impact of that on the volumes and hence near-term financial performance as well. Overall, in terms of profitability, the sales, operating profit, and PAT growth was higher than that of Nifty 50 companies, excluding OMCs, by a wide margin, primarily driven by the non-lending financials. Accordingly, we have been shifting our allocation to the non-lending financial businesses. Practically, if you look at this exhibit, NBFCs and banks put together are close to 50% of the allocation, whereas RTAs, exchanges, rating agencies, and tech service providers are forming a much larger part of the portfolio compared to the past, which is also getting reflected in the performance in recent months, which has been better than the benchmark by a decent margin. In terms of outlook, on the interest rate front, the Monetary Policy Committee minutes highlight that most of the members have suggested for a pause on rate as the risk for both growth, GDP growth, as well as inflation are evenly balanced. And the members of the Monetary Policy Committee are of the view that the confidence on disinflationary trend, while it is providing comfort, we need to wait for a little more before we start cutting rates, because the whole idea is to avoid a spike in inflation at a later stage immediately after there are rate cuts. And as a result, we see a rate easing likely only in the next calendar year, first half of next calendar year. In terms of specific data points on macro, there was upward revision by IMF for the GDP growth estimates for India, and likely the near-term growth is going to be driven by government spending and revival in exports. On the consumption front, it continues to remain a mixed bag, with certain segments doing well, like two-wheelers and consumer durables, whereas discretionary segments have been weak because of extended monsoon and early festive season. Once the harvesting of the agriculture produce is done, probably the cash flow will improve, and that will have a strong bearing on the outlook for consumption of both discretionary and non-discretionary nature. In general, management commentaries during the quarterly result and con call season essentially pointed towards potential recovery in rural demand, driven by a good monsoon during the year, during the season, while urban demand continues to remain subdued. That's where I'll end my part of the discourse. We can open the floor for questions.
Yeah, thank you, Bhavesh, for the session. Request all the participants to type their questions in the chat box. Meanwhile, I have received a few questions. I'll just try to take them. Deposit growth, as you mentioned, has been low because a lot of flow has been moving towards capital markets. So how do you see these flows coming back, or what RBI should do to get these flows back in terms of banking CD growths?
Well, the capital market is often blamed for taking away deposits. That clearly does not seem to be the case, because let's say I am a buyer and you are the seller. If I buy, money will move out of my deposits but will lend in your deposits. So the deposit of that money continues to remain in the system. So capital market is not a major contributor behind deposit growth being weak. The probable reason, in my sense, is the fact that since COVID, Indian economy has been charting the recovery in two phases. There is a segment of population which is still, reeling under the influence of post-COVID challenges on growth front, has not seen cash flows reviving to pre-COVID levels. That is when we are talking about the rural distress. That part is also leveraged, as is indicated by the microfinance sector. So when you have cash flows which have not recovered to pre-COVID levels, when you see over leveraging, then essentially, the ability to create deposit gets impaired, because manner in which deposit gets created is also through credit. Now, this is for the part which is under stress. The part which is not under stress, which is, let's say, large corporates, which have seen decent cash flows, decent earnings, but they are not willing to put in money in new capex plans. And hence, the government of India has been driving the capex bit in hope that eventually the private capex would bounce. So far, that has not happened. And both of these factors, the part which is doing good, not willing to leverage, the part of economy which is not doing well and is over leveraged, in combination has led to a situation where deposit creation is not happening, and hence this situation.
Okay, thank you for a detailed answer. Uh, Other question is banking and financial sectors contributes to almost 40% of the profit pool of the listed entity. So
So,
apart from valuations, what do you see that would trigger the momentum into this sector?
so as you can see, I mean, uh, so far what we have discussed through the presentation, we can see that the lending part of the financial services is witnessing earnings pressure because of lower margins and gradually inching NPAs. Now, this trend will continue for a while because once the rate cuts start, you will have lending rates going down further and hence additional pressure on the margins for lenders. Meanwhile, asset quality pressures, it cannot improve from here dramatically. So there is only one direction it can go. It can at best remain stable or inch up. As a result, we have to be very selective in selecting the stocks where NIM compression would be least, where asset quality pressures or risk are least. Uh, in contrary, if you look at non-lending financials, the growth rates there are very impressive, both on revenue front and on the bottom line front. However, there are regulatory actions happening on the capital market front, as we have seen new guidelines for the F&O trading. The implications of all those measures will be visible, from November, December, January onwards on the volume. The volumes are already down on F&O front. So, in one sense, the best performing market part of the financial services sector too has some challenges on the way. Uh, in response to all the situation, uncertainties and all, we have tried to maintain a fine balance between good quality lenders as well as good quality businesses on the non-lending side. And that combination has delivered the result in recent months. At right time, if you're asking about when the fortunes for lenders will turn, uh, it is going to get increasingly more and more stock specific. So far, the entire sector was doing well. Now, the good ones and bad ones probably will get differentiated treatment as we move forward, depending on the asset quality trends. So I would say one should continue to follow a policy where one is allocating more money towards quality financials where asset quality risks are least.
Yeah. So in fact, I would also received a question regarding we exited IndusInd Bank, citing a risk of microfinance asset quality risk. Do you
Correct.
think any other lenders are facing such kind of challenges? And do you consider it to be re-entry level because post the correction, because post exit, I suppose stock had corrected heavily because of this news
Sure.
of microfinance. And where do
So
you
in
see such kind of risk in other banks also?
sure. So in fact, IndusInd is not the only name we exited on account of this. Uh, there is Credit Access Infusion, which we exited at opportune time. There again, the reason was microfinance business. And earlier, we had exited AU Bank because after the merger with Fincare Small Finance Bank, they too have about 10-11% exposure to microfinance. In terms of the prices, while pure microfinance player like Credit Access, Fusion, Spanna Spurti may look very cheap compared to where they were earlier. Uh, you know, the challenges are not completely behind for microfinance business. And the reason why I say this is uh, the collection efficiency for all these players is still weak. So, what do I mean by collection efficiency is if in a month a microfinance company was supposed to collect 100 rupees from the borrowers, they are able to collect probably 96, 97% only. So every month there is addition to GNPA. First, this collection efficiency has to improve, which probably could start happening once the cash flows for the rural borrowers improves after the harvest. Uh, and at the same time, we also need to give time to the sector to bring down the over leverage. We saw in the exhibit that more than four loan borrowers are still a sizable portion. Now, you cannot certainly call back the loans on an ad hoc basis. So, for the over leveraging to normalize down, for MFIN guidelines to have beneficial impact on the sector's fortune, it will take few quarters before the benefits are visible. So in the near term, the asset quality challenges are here to stay. We are monitoring the space very closely. Wherever we have lead indicator data to rely on, and at opportune time, if it makes sense on risk reward basis, we'll consider re-entering them again.
Okay. Thank you for the detailed understanding. Again, recently, IRDA came out with a norm that private banks should not focus, at least 50% of the business should not come from an single bank, wherein, say, HDFC, if you look at HDFC life insurance or an SBI life insurance, 80-90% of the businesses are done by the home branch or the home bank. So what do you think that will this impact on the revenues of life insurance company going ahead?
Sure. So, this in fact happened yesterday. We had seen all the life insurance stocks down materially. In response, insurance companies have come out and said that there is no such discussion or consideration on the table at this stage. But let us just assess this proposal of removing the concentration. And I'll take the example that you just gave, that all these life insurance companies, the leading ones, are sponsored by a bank, and majority of the sales that a bank does for life insurance category goes to their own insurance company. The capping proposal, let's say tomorrow it is capped to 50%, right? Uh, the actual implementation of such a measure will be extremely difficult. The reason is one may keep, let's say, talk about a State Bank of India branch. They'll keep product of two or three life insurance companies. Once the sales hits 50% for SBI Life, will the bank force customer to choose the other products?
No,
You
it is
know,
not a practical possibility.
correct. So while the concern of mis-selling may be justified, and it is justified because of the fact that most life insurance customers tend to discontinue their policy. That is, at least half of those customers tend to discontinue their policy at the fifth year, which is called persistency ratio. So if you look at 61-month persistency ratio for most insurance companies is in the range of 50 to 60. That means 40% of the customers tend to leave. Now that's not a great metrics to have at industry level. And hence I'm of the view that the concern is valid. But the proposal that is going rounds, is that the solution to the problem? I'm not too sure. Uh, and in any case, proposal of such nature which have huge ramifications for the revenue, are generally taken after consultation of the players involved in the industry. And so, if there is any consideration from IRDA to cap or reduce the concentration, probably they'll float a consultation paper before they come out with guidelines. And even when it will get implemented, I would assume they'll give a glide path to this insurance companies in terms of how much sales is coming from the parent bank. Uh, so, as far as the current situation is concerned, uh, as life insurance companies have pointed out, there is no such proposal on the table.
Yeah, then only time would tell how things move ahead.
Certainly.
Yeah. Any recent addition in our portfolio? And a few of the stocks which are rallied by more than 100% in last 1 year, like K Fintech, CDSL, BSE, and Multi Commodity Exchange. More of them have rallied more than 100%. You reflected in terms of earning growth of 30% plus in each of them. What's your view going forward for all of this four of them?
Well, for exchanges, I just mentioned that there is a set of guidelines on derivatives, which has come into effect from this month. In fact, yesterday itself, BSE decided to move its expiry from Friday to Tuesday. There will be contracts that will end. Uh, you know, the weekly contracts will end, and probably they'll move to monthly. So we are in a phase where the uninterrupted growth in volumes has been interrupted by regulations, new regulations. So we are monitoring that situation closely. So far, in first few days of November, while the volumes were lower than that of September and October, they were still above the July volumes. So we need to monitor incremental trends. And all these entities have some or the other tool available to reduce the impact on revenues because of these regulations. So we'll see all those things happening over a couple of months, and in line we'll take the call on them. On what was the other question?
A new addition into the portfolio.
New addition, yeah. So we have added Muthoot Finance recently, largely driven by the fact that that is one segment where asset quality risk is least, and because of the fact that gold price has been going up and is still higher than what it was a year back, there is a lot of demand for gold loans, especially when all these fintechs and unsecured lenders are taking a step back because of asset quality challenges. Some of these borrowers will end up taking gold loans, and hence demand environment for gold loan as well as asset quality, picture for gold loan is relatively better than some of the other lenders, and hence we decided to enter the name.
Thank you. Last one. Uh, what's your view on three of the PSUs being held in our portfolio: SBI, Bob, Bank of Baroda, and REC? These are the three lenders only available in our portfolio. Yeah.
Sure. So SBI and Bob, both of them are not very demanding in terms of valuation. They are both trading at around 1.1 time price to book. And in comparison to the ROE they are generating, all these three PSUs are trading at very reasonable multiples. And as we saw in the exhibits, the loan growth continues to remain pretty healthy for SBI. The return on asset is better than what it was a year ago. So because of the fact that financial performance continues to remain better, we are continuing to hold on that. Similarly, for REC, the entire lending space for the infrastructure sector, especially power, and within that, renewable power, that is one fast growing area, which is visible in loan growth for REC as well as PFC. Between the two, the growth rate for REC is better than PFC. And in context of the ROE they are generating, which is again upwards of 18%, the current valuation of 1.4 odd, of 1.4 times price to book, uh, offers upside to us, and hence it's a hold for us.
Uh, just coming back to again SBI, what would the exposure of Adani Group towards SBI, and any material impact of the recent news regarding Adani going ahead in the market in terms of lending book for SBI?
Well, they generally don't share such specific disclosures for individual borrowers. And here, in case of Adani, the concern is not for the entire group, but for certain specific entities. And so there is no public disclosures on specific entity exposure. All the data one can get from ROC, that is Register of Companies, typically is of the sanctioned loan and not the loan availed. So that also doesn't complete the picture. And the third aspect is such exposures tend to include both non-fund as well as fund-based exposure. The relatively relevant portion is generally the fund-based exposure. So there are no public disclosures really to share with the participants at this stage.
Thank you, Bhavesh. In fact, you gave a quite in-depth, and I feel our portfolio is quite balanced in terms of private lenders, public sector lenders. In fact, across the financial sectors, we have a great exposure in terms of we have life insurance company as a part of the portfolio, even say exchange like BSE, multi-commodity exchange. So it's a well diversified financial basket which is available. I truly like the portfolio. I would request all the participants, if there are any further questions, you can just type it down. Uh,
I think there is one in the chat box from
yeah,
Ashish.
yeah. Are banks having 50% revenue through
Banca products.
banca products currently?
So for banks, banca products are part of the fee income. The interest income through loans is much larger portion for banks.
Yes.
But if we reverse the situation, that how big is banca channel for life insurance company, then the picture is that for except for ICICI Prudential, for all the other life insurance companies, the contribution of banca will be 50 to 60%. And that makes it sizable channel. Some of the products like ULIP are typically more amenable to bank assurance channel. And so for the sales of products like ULIP, it is significant, the banca channel. And hence, regulations such as the one we were talking about, which is putting a cap on how much can come from the parent bank. If there are caps on that contribution, there will be serious implications. But implementing such measures as are talked about in the rumors is not easy, and ideally we should wait for the guidelines to come in so that even stakeholders, life insurance companies, will also get an opportunity to present their view, and only after significant consultations will IRDA come out with the final guidelines. I hope that answers your question, Ashish.
Yeah, thank you. I think there are no further questions, and we thank all the participants for joining the call. Thank you, Bhavesh, once again for a detailed update about the portfolio. We shall conclude the call now. Thank you once again.
Thank you. Thank you, everyone. Good day.